Welcome to Morningstar. I'm Larissa Fernand, and with me today is Rajeev Thakkar, the Chief Investment Officer at PPFAS Mutual Fund. Rajeev, thank you so much for being here today.
Pleasure being with you, Larissa. Thanks.
Rajeev, my first question to you is that you've been around for 2 decades operating in a fiduciary capacity, and you had once said that a very successful trade of an investor is to be able to recognize when you are wrong and change course. So can you give me one or two examples where you have really changed course when it comes to your investing style, where you realize something was wrong?
Sure. So initial years, I was driven a lot by the statistical cheapness of a company or the attractive valuation of a particular company. And one was a bit lenient on the business quality and things like that. But over the years, the realization crept in that if one is holding the stock for a longer period, the other qualitative aspects also come to the fore, and one cannot just go by statistical cheapness. So I think to that extent, it's a slight shift in the way we look at companies and approach investing. It's not a 180-degree change or something like that. It's more of a small course correction in that sense. So even today, at times, there are situations where things are so cheap that even looking at some of the negatives, it still makes sense to invest. But gradually, the as we've lengthened the holding periods, the qualitative aspects have come to the fore more often. Some of the things, so you mentioned about recognizing where one is going wrong. So one of the patterns that we have seen in the Indian context is that there have been situations where populism takes precedence over business economics. So where a sizable section of the population is affected by a business decision, this could be in the field of infrastructure, it could be in the field of edtech, it could be in the field of microfinance, it could be in the field of healthcare. So effectively, what society and what the government at large, policymakers, even courts, will decide that a lot of people are affected. It doesn't matter if investors lose some money, so be it. But we will make sure that the common person is not inconvenienced. So to that extent, we have been a bit more circumspect about investing in spaces where there could be these kind of interventions.
Oh, okay. That was interesting. How do you how do you get your resilience then to stand against the crowd? Because your investors will walk up to you and say, "Why aren't you doing this? Why aren't you investing here?"
So that keeps happening. And every year when we interact with our unit holders, and we do this once a year, people go through the portfolio statement and fact sheet line by line, and they pick up companies that are not doing well. And typically, all the questions are around those companies. Luckily, if on an average you are doing okay, the questions are not that hard, and people are willing to give you that time, and they realize that it's a probabilistic thing. Not all stocks will do well all the time. So they are a bit lenient in that sense. Difficulty really starts when a substantial portion of your portfolio is not doing well. So resilience is fine if small portion of your portfolio is not doing well. More difficulty comes about when a large portion of your portfolio seemingly is not doing well. And for us, these problems have been more pronounced in bull markets rather than in bear markets. Data from Morningstar itself. So if you look at the quantitative data for our schemes on the Morningstar portal, our upside downside capture ratios. So on the upside, we do less better as compared to the category averages or the indices. And on the downside, we fall much lower. So in very, very pronounced bull markets where there is froth and where we are a bit cautious, that's when people tend to see the underperformance of the scheme. And at such points in time, we have to really communicate to the investors that please judge us over a market cycle rather than doing it over short-term time spans. And then we also get into the rationale about individual holdings that we have, or the rationale behind a little bit of cash holding that we might have at that point in time. So really, it's about aligning the end investor, aligning with the advisors and distributors, and our own internal team. So if all are in alignment, that gives you resilience, that gives you the conviction to stay the course. Otherwise, things become difficult and people tend to stray.
Does any of it ever give you sleepless nights? I think the bull market gives you more sleepless nights than the bear market.
No, I don't have too much problems with sleep, except when I'm binging on OTT content. So yeah, sleep is not a problem as long as the process is fine and things are going normally. I don't tend to obsess too much about scheme performance and things like that, because one has this prior understanding that there will be periods where overall markets will not go upwards. They go up and down all the time, and one has to be in it for the long term to really get the returns. And the second is the understanding that every active strategy will have periods where it will not do as well as the benchmarks, and one has to be prepared for short periods of underperformance. So this one is ready even before one sets out on the journey. So then one doesn't lose sleep as and when those events happen.
Mentally and emotionally, how do you identify yourself as an investor? Don't you find that these silos of value investor and I'm a growth investor and is too restrictive? It sort of ties up your hands. Don't you feel so?
Absolutely. So I don't classify ourselves in one particular bucket, and we are more in tune with the approach of Buffett and Munger, who say that growth is a component of value. So when you are finding the intrinsic value of a company, you have to factor in growth. Now, growth sometimes adds to the intrinsic value, sometimes it reduces from the intrinsic value, ironically. If growth comes at decent ROC, it adds to the value. But if the return ratios are very bad and if the company is growing, then sometimes, in fact, it destroys value. So we don't classify ourselves into these buckets. At one end, we will have tech companies in the US in our portfolio, which typically people classify as very high growth companies. And at the other end, we'll have stocks in the mining business, which are very, very mature old businesses, and people don't see much of a growth in that space. So we have all kinds of companies in our portfolio.
Am I right in saying that you're very averse to companies that have leverage? Is that so?
Largely, yes. The financials, of course, are very leveraged businesses by definition. So we have banks in our portfolios, which are leveraged businesses. We have some utility kind of companies which also have leverage built in as part of their business models. What we are against is we are against very high leverage in companies where it could pose a survival risk in a downturn. So that is what we guard against. Now, just to give an example, if one is in a vulnerable sector and COVID hits, let's say you are in the hospitality business or if you are in the physical retailing business and COVID forces you to shut your business for 6 months or 12 months, and if you are not able to repay your interest and principal that is due, then you could go into liquidation, even though otherwise the business is good and otherwise it is well run. So, what leverage does is it enhances returns for equity shareholders sometimes, and it also increases risks in a lot of cases. We are happy to let go of a little bit of return in favor of resilience and in favor of longevity.
And in your personal life, are you averse to leverage in your own personal circumstances? Does it also fall over in
Yeah,
that?
so does aversion to leverage have anything to do with my personal experiences? Not so much in terms of my individual finances. So I have had tiny mortgage loan early in my investing career where it was giving me tax breaks, and also it was well within the monthly cash flow that I had. So it was not so much of a challenge financially. Early in my professional career, I worked with a investment bank which was leveraged and which invested in equity. And in a downturn, it had difficulty running ship. So to that extent, I've seen at close hand what leverage can do in a volatile business. That is something that is there in my experience.
What principle do you believe that applies to investing, and you can also apply to your personal life?
Associating with good people, Larissa, I think. Just like in personal life, one does not want to associate with cheats or liars or people who are continuous takers who make you foot the bill every time you go out for a meal. You want them to be fair in their dealings with you. Same way you want those characteristics in terms of your promoters with whom you partner or business managers of the companies where you invest in. You want them to communicate what is happening in the business with truth and fairness. We want them to share all the relevant information with us. We want them to be paid fairly, not underpaid, but at the same time, no over the top managerial compensation. We want them to do related party transactions at arm's length basis. We don't want them to enrich themselves at the cost of minority shareholders. So essentially, the same characteristics you look for in terms of people you associate with in personal life, that same extends to investing as well.
So, how do you ensure that your own biases, your own prejudice, your own experiences don't cloud your judgment when you're dealing with money?
Yeah, so one thing is being aware of what are the typical biases that people fall prey to. So reading on some research that has happened over the years in terms of the field of behavioral economics and behavioral finance, that helps. So things like sunk cost fallacy or things like recency bias and all of that, being aware of those biases at least helps you a little bit in terms of mitigating them. The other things are some of the institutional frameworks that are there in terms of the risk control mechanisms, not to go overboard in terms of over optimism, in terms of position limits and things like that. Also, we have a small team which challenges one another in terms of my colleagues have a different opinion on something, then they voice that, and which forces me to rethink whether I'm going wrong in some manner or things like that. So, all these things help.
Can you specify one bias you have successfully overcome, or at least you're successfully very aware of yours?
Uh, I think I've been able to largely overcome the greed and fear kind of yo-yo that happens. So in our own journey, we have been able to live with underperformance in extreme overheated markets. So this would be in 2017, let's say the small and mid cap rally, or in 2007 in the PMS days when things like real estate, infrastructure, and commodities were the hot stocks, and they were at frothy valuations. So that is as far as greed goes. And in terms of fear as well, we were able to deploy money in March and April of 2020 when people were very, very fearful, and there was this big worry around COVID and how that would affect things down the road. So, focus on business valuations and business characteristics and tuning out of the overall macro noise or the environment. I think that is something that individually and as a team we have been able to more or less navigate over the years.
Oh, that's lovely. Good. That's good. Tell me one thing. How important are first impressions to you? Whether you in your personal encounters or when you meet promoters or management?
Typically, we try and avoid investing with people who have been around for a very short period of time. So, the people with whom we typically invest, we have seen them behave as a listed company or a listed business house for 5 years, 10 years, or more. Typically, we don't have a one meeting with a new listing or things like that. And based on that one meeting and impression in that one meeting, we go ahead and invest with them. Also, the qualitative impressions have to be backed by the deliverance of financials over a period of time. So, someone may come across as a very impressive individual, or they may have good things to say, but if their P&L, balance sheet, and cash flow statements are not showing that, then we would stay away from such people and businesses.
Has meditation helped you be a better investor?
Absolutely. So just like when our computer slows down, a reboot helps in most cases where the RAM gets cleared and your programs start running faster. So meditation in terms of tuning out of all the thoughts and focusing on simple things like your breath going in, coming out kind of thing, or just slowing down all the processes helps you once you come out of it think clearly and see things for what they are rather than perturbed by the various stimuli that are coming your way. It has helped me a lot.
So, Rajiv, investing is all about probabilities. You will agree to that. So, how do you make sure that the odds are always in your favor? How does luck, destiny, and all this, how does it play out in your mind?
So I think the framework of Michael Mobison in terms of skill versus luck really is something that we look at and where investors should also look at. So, like he has explained, at one end, let's say there is a slot machine or a roulette table, which is completely about luck. And at the other extreme, you would have a game of chess, let's say, which is completely about skill, where the better player would win. Now, investing obviously falls somewhere in between. In the short run, over 1 month, 3 months, 6 months, luck would have a very, very large role to play where the way things pan out, whether in terms of capital flows coming in, going out, or interest rates, or geopolitical events, and things like that. But if one looks at it over a decade or more, then more of skill would come to the fore as good luck and bad luck would tend to cancel each other out over the long run. And mostly it would be about skill, about the skill of the team or the individual. So what we see is that how do you get probability in your favor? So one of the things that you mentioned was leverage. If you dial down the leverage in the businesses that you own, the chances of being in the game for long run improve, and you can't be forced out of the business because of banks seizing the asset. The second is the choice of the promoters and managers. If they are competent and they are fair and honest, then again odds tend to work in your favor. The third thing would be the limited competition. If a sector or a business is very, very competitive, then chances of the business going down are high. So, some of the things which history has shown us that these are the things that are the attributes of successful businesses and successful investments. We try to work on those parameters and try and ensure that on an average, the investee companies in our portfolio will do well for us. It's not that all stocks will do well all the time. There will be businesses which don't work the way we anticipate them to. But as long as on an average we are doing well, we should be okay.
What is one trait that you find in others that immediately repulses you?
Again, what I mentioned earlier, where people tend to enrich themselves at the expense of others. So I've seen businesses and promoters where the promoter's lifestyle is completely over the top and the business is either reporting losses or showing a return on capital employed, which is less than what the bank fixed deposits give. So if the businesses are earning, let's say, 5% ROC, and if the promoter flies around in a private jet where there's nothing important that the promoter is doing and has a fleet of maybe 10 luxury cars and mansions to live in, that really puts me off in the sense that they are just abusing the trust that minority shareholders have placed in them.
Okay, and my last question to you is there any skill set you're trying to develop right now or any behavioral bias you're very focused on right now that you want to hone? Any skill that you want to develop right now?
Our usual investing process continues in terms of looking at each business individually and the bottom up approach that we have for investing. What we are working on is we are working on using some of the newer computing tools that are available, the alternative data sets, the advances in the field of AI. Can those act as some early warning signals for some of the companies where we have investments in? If something is going wrong, can they identify some flaws in the investee companies? And at the same time, can they highlight some potential investments where those companies are currently not on our radar but would look promising for our investing approach? So we are working on developing some of these tools.
Rajiv, thank you so much for your time. I really appreciate you talking to me. Thank you.
Thank you for the opportunity, Larissa.
This is Larissa for Morningstar. Thank you for watching.